The vast majority of market participants operate under a fundamental misconception that market bottoms will announce themselves through unmistakable signals, positive earnings reports, bullish analyst upgrades, or clean technical breakouts above resistance. This pervasive belief represents precisely the illusion that the composite man, Richard Wyckoff's term for the coordinated behavior of informed capital, meticulously cultivates. True accumulation is intentionally engineered to appear boring, ambiguous, and uncomfortable, ensuring the crowd remains sidelined while substantial positions are methodically built at favorable prices. Wyckoff observed that accumulation is not a parade but a quiet campaign. The professionals who control significant capital cannot afford to telegraph their intentions through obvious signals that would attract competing demand and drive prices higher before their positioning is complete. Instead, they prefer the camouflage of confusion, contradiction, and fear conditions that keep inventory available while shares transfer from weak hands to strong. The myth of the clear bottom thrives because people remember the headline that accompanied the rally, not the months of tedious range-bound action that preceded it. In reality, the early foundation of a bull move rarely looks encouraging. The tape prints lower lows that immediately reverse, wide spreads that close in the middle, rallies that fail and then fail to follow through lower. To the untrained eye, these are mixed signals. To the Wyckoffian eye, they represent the first hints of stopping action and absorption, large effort pressing price downward that achieves progressively less result. This systematic process begins with a selling climax that drains panic selling, followed by an automatic rally that shocks the bears, and a secondary test that verifies whether major selling pressure has truly dried up. When price later dips below familiar support, it often does so by design. The spring is not a magical pattern but a deliberate probe push price just far enough to trigger stop losses, harvest liquidity, and then reveal underlying demand by snapping back above the break with authority. Only a successful test, quiet and narrow after that snapback, confirms that supply has been absorbed and the danger point exists. The reason 90% never notice hidden accumulation lies not in the absence of information but in the seduction of narrative. Headlines amplify the pain of the prior markdown. Indicators provide conflicting signals, and memory weights recent losses more heavily than emerging structural evidence. Hope demands certainty. Discipline accepts what the market actually reveals, rather than what emotional comfort suggests it should reveal. This is why accumulation resembles purchasing fire insurance. It provides maximum value when acquired during periods of apparent danger, when premium feels expensive, when the benefit remains invisible until hindsight makes the opportunity seem inevitable. Value is secured when others demand reassurance. Edge is earned when one reads the tape instead of the headlines. The trader who learns to recognize stopping action, respect the spring and its test, and act only at the danger point, makes decisions that feel uncomfortable, yet prove logical. Discipline over emotion, structure over stories, evidence over excitement. These quiet virtues reveal what most never notice. Wyckoff's law of effort versus result provides traders with a coherent grammar for reading the tape, transforming the raw motion of volume and price into a clear language of institutional intention. Effort represents the energy the market expends, expressed through volume. Result measures the distance achieved, expressed through price spread and net progress. When these elements align proportionally, the market behaves efficiently, and the crowd maintains control. When they diverge dramatically, someone with deeper pockets is quietly working against the crowd, absorbing supply or restraining demand, while building the foundation for moves that will appear inevitable only in hindsight. During genuine accumulation, the most revealing episodes are not the dramatic rallies but the stubborn failures of downward pressure. Large volume hammers price lower, spreads widen, fear intensifies, yet the net downward progress diminishes with each successive wave. This mismatch reveals absorption in real time, professionals systematically purchasing shares that emotional sellers eagerly abandon, converting weak-hand inventory into strong-hand control. When tremendous effort produces meager downward result, the composite man announces his presence not through fanfare, but through the tape's quiet whisper of diminishing selling efficiency. Consider a practical scenario where price declines 3 points on massive volume. only to recover 2.5 points by the session's close. The effort was enormous, visible to anyone monitoring volume, yet the result remained constrained. This suggests that substantial capital stepped in to absorb the selling pressure, preventing price from achieving the decline that such volume would normally produce. The market absorbed the fear-driven supply without surrendering meaningful ground, a hallmark of professional accumulation. The inverse signature often emerges after sufficient absorption occurs. Price begins traveling farther distances on reduced effort. Rallies cover more ground with smaller volume, and pullbacks lose their authority. Small effort producing outsized upward result indicates that the wall of supply has been methodically removed. This is not momentum chasing or speculative enthusiasm. It represents market structure, revealing that the path of least resistance has fundamentally shifted. A thought experiment clarifies these relationships. Imagine price revisiting identical support levels twice within a remainder trading range. During the first visit, volume surges dramatically. The price bar widens significantly. The close finishes near mid-range, and the following session denies any meaningful follow-through to the downside. On the second visit to that same level, volume remains subdued. The spread narrows considerably, and recovery requires minimal demand to lift price away from support. The price level remains identical, yet the underlying stories differ completely. The first instance suggests absorption, beginning heavy effort meeting organized resistance. The second reveals supply already thinned, reduced effort immediately rejected by the market's refusal to accept lower prices. Most traders miss these crucial relationships because their attention remains fixated on the price pain of preceding markdowns, while ignoring the quiet transfer of ownership occurring within subsequent trading ranges. They interpret heavy volume accompanying price declines as bearish confirmation, failing to recognize that such volume often represents demand meeting supply rather than panic overwhelming all available bids. They mistake quiet rallies for weakness when these actually signal supply exhaustion and the withdrawal of selling pressure. This law also protects against seductive deceptions. Distribution can masquerade as strength when high-volume advances repeatedly fail to extend meaningfully, revealing significant effort without lasting result. As informed sellers distribute inventory near price peaks, accumulation can appear weak when apparent breakdowns struggle to continue lower, revealing that substantial selling effort cannot achieve proportional downward result because absorption neutralizes the pressure. The intellectual safety of this approach lies in its systematic nature, grounding decisions in measurable relationships rather than emotional comfort or narrative preference. Uncertainty transforms into probabilistic assessment when one learns to read effort relative to result across multiple price swings, rather than interpreting isolated candlesticks or hoping for obvious signals that rarely arrive until opportunities have passed. The discipline involves measuring what actually occurred rather than imposing what the mind prefers to see. Wyckoff taught that arguing with the tape represents ego parading as analysis. When effort and result relationships consistently point toward accumulation, when large selling efforts produce minimal downward progress and small buying efforts generate meaningful advances, the prudent approach involves aligning with what the market reveals rather than fighting these structural realities. The tape maintains perfect honesty, but it requires patient, systematic observation to decode its message before that message becomes obvious to everyone else. Accumulation unfolds not as random market noise but as systematic architecture, each phase serving specific purposes within the composite man's methodical campaign to transfer substantial inventory from weak hands to strong hands without telegraphing his intentions. What appears chaotic to the untrained eye reveals itself as choreographed precision when viewed through the lens of Wyckoff's structural analysis, each movement justified by the volume beneath it and the logic within it. Phase A marks the dramatic cessation of the preceding bear trend through what Wyckoff termed the selling climax. A violent washout, characterized by panic volume, wide price spreads, and the final capitulation of holders who can no longer endure the pain of ownership. This climactic selling exhausts the remaining supply overhang that has been pressuring price throughout the markdown phase, often producing the widest range and highest volume of the entire decline. The moment represents fear reaching maximum intensity as the last committed sellers abandon their positions regardless of price, creating the vacuum that professional capital has patiently awaited. The automatic rally follows immediately, snapping price higher as the sudden absence of selling pressure allows even modest demand to drive significant recovery. This rally occurs automatically because markets abhor the vacuum created by climactic selling exhaustion. The professionals who absorb the climactic supply step aside temporarily, allowing natural buying interest to lift price while they assess whether additional selling waves will emerge. This automatic rebound typically retraces between 1/3 and 2/3 of the preceding decline, establishing the upper boundary of what will become the accumulation trading range. The secondary test represents the market's systematic verification that major selling pressure has indeed been exhausted. Price returns toward the selling climax low, but the effort versus result relationship reveals the fundamental shift that has occurred. Where the original climax required massive volume to drive price to its low, the secondary test achieves similar price levels on dramatically reduced volume, with notably less downward momentum. This test serves multiple purposes within the campaign. It confirms that panic selling will not resume, shakes out any remaining weak holders who survived the initial climax, and provides the composite man with additional opportunities to absorb shares at favorable prices. A successful secondary test holds above the selling climax low or penetrates it only briefly before recovering, demonstrating through the tape's honest language that demand now exceeds supply at these price levels. Phase B represents the methodical building of cause through systematic absorption, the workshop where the composite man conducts his most important work. This phase often proves the most challenging for retail traders because it appears tedious, contradictory, and devoid of obvious direction. Price oscillates within the trading range established by the automatic rally high and the selling climax area, creating repeated opportunities for professionals to accumulate inventory whenever weak holders grow impatient or fearful. Each decline within this range encounters buying interest that prevents meaningful progress below established support, while each rally meets sufficient supply to prevent premature breakouts that would attract competing demand. During Phase B, the tape reveals its secrets through the effort versus result relationships that become the trader's compass through intentionally ambiguous price action. Down moves within the range require increasing effort to achieve diminishing results, as absorption systematically removes available supply. The volume expands on declines, yet price progress diminishes with each successive wave, revealing professional demand stepping in to absorb the weak-hand inventory. Conversely, up moves begin requiring less effort to achieve meaningful progress, as selling pressure diminishes, though these rallies often stall at predictable resistance levels to maintain the range-bound appearance that keeps the crowd disinterested. The longer this construction persists without lower lows of substance, the more substantial the cause being built for future effect. This phase tests the patience of all participants. The professionals must resist the temptation to drive price higher prematurely, while retail traders must endure the frustration of sideways action that provides no obvious directional signals. The systematic removal of supply overhang that would otherwise cap any significant advance prepares the foundation for eventual markup, though this preparation remains invisible to those focused on price bars rather than volume relationships. Phase C delivers the crucial spring or terminal shakeout, a deliberate manipulation designed to clear the remaining weak holders and create the final opportunity for accumulation before markup begins. This is not simply an undercut of support, but a liquidity harvest engineered to expel weak holders and collect their shares at a discount. The spring pushes below the established floor just far enough to trigger stops, attract shorts, and confirm every bearish narrative still echoing from the prior markdown. The volume signature during a spring reveals the manipulation in real time. The initial breakdown often shows expansion in volume as stops are triggered and bears pile on, yet the recovery demonstrates even greater volume expansion as demand overwhelms the induced supply. The tell comes not from the violation itself but from the behavior immediately afterward, a swift reclaim of the range, a close well back within prior structure, and a subsequent test that is quieter, narrower, and starved of selling pressure. The spring serves as both test and trap, probing for remaining pockets of supply while trapping bears who interpret the breakdown as trend resumption, only to find themselves squeezed as price recovers with authority. Not every accumulation campaign requires a dramatic spring. Sometimes a terminal shakeout hides as a marginal breach followed by a dry-up in volume. Context becomes the arbiter, because the direction that preceded the range and the amount of absorption achieved in Phase B determine whether a breakdown represents genuine weakness or theatrical deception designed to harvest the final liquidity before markup commences. Phase D reveals signs of strength and establishes last points of support as the accumulation campaign nears completion. Price begins holding above previous resistance levels within the trading range, demonstrating that the supply which formerly capped advances has been successfully absorbed. The effort versus result relationship tilts decisively in favor of higher prices as rallies extend further on reduced effort, while pullbacks find support at progressively higher levels, creating the stepping stone pattern that characterizes the transition from accumulation to markup. Signs of strength during Phase D often manifest as price gaps, widespread advances on expanding volume, or the ability to close near session highs despite intraday volatility. These episodes reveal that the balance of power has shifted decisively in favor of demand, though the broader market may not yet recognize this structural change. Former resistance begins to hold as support, and last points of support appear like stepping stones, each offering a logical danger point, where risk can be defined tightly against the structure. The tape finally cooperates with disciplined analysis. Demand shows itself when invited, supply withdraws when tested, and the market demonstrates its readiness to reward patient accumulation. Phase E marks the transition to markup as price breaks above the trading range with authority, confirming that the accumulation process has reached completion. This breakout typically occurs on expanding volume with wide price spreads, demonstrating that demand has become urgent while supply remains scarce. The break carries not because of enthusiasm alone, but because the wall of supply behind price has been systematically mined and removed during months of quiet accumulation. Follow-through replaces hesitation. Consolidations form above former ceilings, and pullbacks tend to stall where resistance once repelled. The breakout validates the entire accumulation campaign, proving that sufficient cause has been built to support a proportional effect in the form of sustained price advancement. What once appeared random now reads like choreography. The concealed intention of the composite man revealed only after his methodical work reaches completion. The blueprint transitions from construction to execution, cause becomes effect, and the campaign moves from the hidden preparation phase into the visible markup that will eventually seem inevitable to those who missed the systematic accumulation that made it possible. This architectural framework provides the systematic observer with a roadmap for recognizing accumulation as it develops, rather than identifying it only after markup has made the opportunity obvious to everyone. Each phase serves specific purposes within the larger strategy, and each provides observable evidence through price and volume relationships that can be analyzed in real time rather than identified only in hindsight. The professional campaign unfolds according to logical necessity rather than mysterious forces, making it accessible to traders willing to study the tape with patience and discipline rather than hoping for obvious signals that rarely arrive until opportunities have passed. The danger point represents the precise intersection where accumulated evidence transforms into mathematical advantage, where systematic analysis crystallizes into actionable opportunity with clearly defined risk parameters. This concept transcends mere technical entry signals, embodying Wyckoff's principle that successful trading demands waiting for the market to extend a genuine structural invitation, rather than forcing participation based on hope, prediction, or emotional urgency. The danger point emerges only after the accumulation blueprint has been thoroughly validated through price and volume evidence, creating an asymmetric risk-reward profile that justifies capital commitment. Execution begins where structure clarifies risk, but structure must be established with rigorous precision before any consideration of entry. The systematic approach demands confirming that a legitimate selling climax has occurred, evidenced by panic volume, wide spreads, and the exhaustion of selling pressure that produces an immediate automatic rally. The secondary test must demonstrate through effort versus result analysis that major supply has indeed been absorbed. Similar price levels achieved on dramatically reduced volume with minimal downward momentum confirm that the balance of power has shifted fundamentally. This architectural validation provides the foundation, but the danger point materializes only when the market provides specific structural confirmation through a spring, successful test, or last point of support following a sign of strength. The trading range established between the automatic rally high and the selling climax area becomes the laboratory where accumulation either proves itself or reveals its absence. Repeated tests of support within this range must show diminishing selling pressure, while rallies begin requiring less effort to achieve meaningful progress. The systematic removal of supply overhang creates the foundation, yet the trader's objective remains not to predict a breakout, but to participate when the market quietly verifies that supply has been neutralized and the path of least resistance has shifted. The cleanest invitation often follows a spring that snaps back above support and then pauses, creating the precise conditions where risk can be defined with mathematical precision. The spring serves as perhaps the most reliable structural invitation when executed with proper volume characteristics and immediate recovery. The initial breakdown below established support triggers stops and attracts short sellers, creating artificial supply that professional demand systematically absorbs. However, the spring itself is not the trade. The test is. The critical evidence lies not in the violation itself but in the behavior immediately afterward. Volume expansion on the recovery that exceeds the breakdown volume, swift reclamation of the range, and a close well-back within prior structure. The subsequent test of the spring low provides the optimal entry location, typically characterized by narrow spreads, reduced volume, and immediate rejection of lower prices. This test represents the danger point because risk can be defined precisely below the spring low while the reward potential encompasses the entire effect that the accumulated cause should produce. After the recovery, a narrower, quieter pullback that holds above the spring low declares that the forced sellers have been exhausted and that the composite man is no longer allowing price to revisit liquidity without opposition. The danger point resides at the pivot of that test because a stop can rest just beneath it, and any immediate failure exposes minimal capital while confirming that absorption was incomplete. The market has essentially completed a stress test of its newly constructed foundation. If the structure holds firm under this final pressure, then participation becomes not an act of hope but a logical commitment to the market's revealed truth. When accumulation develops without dramatic springs, the danger point often emerges at last points of support following clear signs of strength. These signs manifest as price gaps, widespread advances on expanding volume, or the ability to close near session highs despite intraday volatility. The pullback to test these signs of strength creates stepping stone patterns where former resistance holds as support, providing logical entry locations with tight risk parameters. Each last point of support becomes a new danger point, a fresh opportunity to add or initiate with tight definitions of risk because the structure itself now buttresses the position. Former ceilings function as floors, not by magic but by the absence of inventory available to sell at those levels. Volume diagnostics provide real-time validation of danger point entries, distinguishing authentic accumulation from deceptive consolidations that may appear similar but lack the underlying absorption that justifies participation. Rallies that previously required heavy effort now travel farther on moderate turnover, while pullbacks lose authority and begin arriving with dehydrated volume, as if the market simply refuses to find enough supply to press lower. Low-volume rallies within the trading range often represent distributional noise rather than genuine demand, while low-volume pullbacks following signs of strength indicate supply withdrawal and validate the accumulation thesis. The tape maintains perfect honesty about these relationships, revealing through effort versus result analysis whether demand has indeed overwhelmed available supply at critical structural levels. The invalidation level serves as the systematic trader's anchor to reality, the precise point where the accumulation thesis proves incorrect and capital preservation takes precedence over hope. This level sits just below the successful test or spring recovery, typically allowing for minor penetration to account for normal market noise while maintaining the structural integrity of the accumulation pattern. When price violates this level with authority, particularly on expanding volume with wide spreads, the systematic approach demands immediate exit regardless of emotional attachment to the original analysis. Invalidation is not a feeling, but the specific price that contradicts the very premise of the entry, transforming what appeared to be systematic advantage into clear evidence that the structural thesis was premature or incorrect. Position sizing at the danger point requires calibrating risk to the magnitude of cause that has been built during the accumulation campaign. A range that consumed weeks to absorb supply implies a modest effect. A range that required months suggests a campaign worthy of patience and substantial size. The asymmetry at the danger point compounds this logic mathematically. A stop positioned 0.5 of a percentage point below a successful test can underwrite exposure to a multi-percentage advance if the range ultimately resolves into markup. This mathematical advantage lies in the compressed distance to invalidation, typically representing 1 to 3% of entry price, contrasting sharply with potential rewards that may encompass 10 to 30% advances when substantial cause has been properly built and absorbed. Risk management extends beyond simple stop placement to encompass position management, as the accumulation thesis either validates or fails. Additional shares can be added at subsequent last points of support as the markup phase develops, using the same tight risk parameters that govern the initial entry. Each addition requires fresh structural evidence, rather than averaging down into weakness, maintaining the discipline that separates systematic accumulation from hope-based position building. The original danger point entry provides the foundation, but subsequent additions must earn their place through continued evidence of professional sponsorship and structural integrity. The psychology of this methodology feels counterintuitive because the best entries occur when individual candlesticks appear unimpressive, when headlines remain skeptical, when the test seems almost too quiet to matter. Yet that quietness represents the point of maximum structural advantage. The successful test of a spring or last point of support often produces visual imperfections, narrow bodies, long wicks, indecisive closes, yet these apparent weaknesses often accompany the most reliable danger points because they reflect the market's unwillingness to accept lower prices, despite the surface appearance of uncertainty. A structure that holds under light probing has completed its stress test. A foundation that does not crack under weight can bear a larger build. Common execution errors stem from impatience, fear, and the seductive appeal of patterns that appear similar but lack proper structural foundation. Chasing breakouts above accumulation ranges abandons the mathematical advantage of danger point entries, accepting higher prices and wider stops while sacrificing the structural evidence that justifies participation. This hands the composite man superior prices and inferior terms, reversing the systematic advantage that patient analysis had revealed. Mistaking redistribution for fresh accumulation leads to entries in patterns that appear constructive, but actually represent distribution at higher levels, lacking the volume absorption characteristics that distinguish genuine accumulation from institutional selling campaigns. The most insidious error involves abandoning valid setups due to uncomfortable price action during the test phase, confusing visual comfort with structural validity. Systematic traders must distinguish between price action that feels emotionally comfortable and price action that provides mathematical advantage, recognizing that the best opportunities often arrive disguised as apparent weakness. When one knows precisely what to do, when to act, and exactly where one is demonstrably wrong, the emotional tumult that plagues most traders significantly diminishes. This framework provides an antidote to prediction-based trading, replacing hope with evidence, emotion with system, and wishful thinking with mathematical advantage. The danger point methodology transforms accumulation analysis from academic exercise into practical edge, providing specific entry criteria, precise invalidation levels, and logical position sizing guidelines based on the magnitude of cause that has been systematically built. Discipline replaces prediction, and the trader executes where the logic resides, at the danger point, when the tape has argued the case and the cost of being wrong remains small enough to be acceptable in pursuit of a reward large enough to justify the systematic campaign. The market extends these invitations regularly to those who understand its language, but it reserves its most generous rewards for traders who respond with discipline rather than hope, system rather than emotion, and evidence rather than the comfortable illusions that seduce the majority into perpetual confusion. The market does not hide accumulation. The mind hides it from itself. Price and volume record neutral facts with perfect honesty, yet human perception systematically filters these facts through the emotional residue of recent pain, the comfort of familiar narratives, and the psychological need for certainty in an inherently uncertain environment. After enduring a prolonged markdown, the nervous system associates entire price regions with danger, transforming every dip near support into a perceived trap and every test into the harbinger of another collapse. Wyckoff's laws remain clearly visible in the tape, yet cognition, scarred by recent losses and primed for defensive reactions, edits this structural evidence to preserve emotional safety rather than recognize mathematical opportunity. This systematic blindness operates with such predictable consistency that the composite man has learned to exploit these psychological patterns as integral components of his accumulation methodology. Professional campaigns are deliberately engineered to trigger the exact emotional responses that keep the majority sidelined, while substantial positions are methodically built at advantageous prices. The crowd's psychological barriers become the professional's strategic advantages, creating a reliable framework where emotional decision-making systematically transfers wealth from weak hands to strong hands. The news follower represents perhaps the most widespread archetype of market blindness, anchoring every decision to external narratives rather than internal market evidence. This trader interprets accumulation through the lens of prevailing sentiment, which during Phase C springs inevitably supports bearish conclusions, because the preceding markdown has created genuine problems that journalists and analysts dutifully catalog. When price penetrates support during a spring, the news follower experiences confirmation of his worst fears, rather than recognizing the liquidity harvest that professional capital methodically orchestrates. The headlines align perfectly with the threatening candlestick pattern, creating an illusion of analytical coherence that masks the structural reality unfolding beneath the surface. This archetype suffers from what psychologists term confirmation bias, selectively processing information that reinforces existing beliefs, while systematically discounting evidence that challenges preconceived conclusions. During accumulation phases, negative headlines proliferate precisely because backward-looking analysis focuses on the problems that caused the preceding decline, yet markets discount future conditions rather than confirming past events. The news follower mistakes this trailing information for forward-looking insight, selling into springs because external validation supports his bearish interpretation, completely missing the volume expansion on recovery that reveals professional absorption overwhelming the induced supply. The recovery from the spring creates cognitive dissonance within this framework, as price behavior directly contradicts narrative expectations. Rather than recognizing this contradiction as evidence that market structure has fundamentally changed, the news follower typically dismisses the recovery as temporary manipulation or dead cat bounce, preserving his narrative framework at the cost of missing the systematic evidence that accumulation is reaching completion. By the time news sentiment shifts positive, accumulation has concluded and markup has begun, transforming what should have been systematic opportunity into expensive confirmation of what price had already discounted months earlier. The pattern drifter embodies a different form of blindness, chasing indicator signals and technical patterns, while ignoring the underlying cause development that creates sustainable moves. This trader lives in the realm of momentum oscillators, moving average crossovers, and breakout signals, missing accumulation entirely because it deliberately lacks the explosive directional characteristics that technical indicators are designed to identify. Accumulation appears boring to momentum-based analysis because professional capital systematically avoids the dramatic moves that would attract competing demand and drive prices higher before positioning is complete. During Phase B, where absorption requires time and apparent contradiction, the pattern drifter becomes trapped in whipsaws and false signals as indicators oscillate without clear directional bias. He chases the automatic rally as confirmation of reversal, then capitulates during the secondary test because moving averages suggest continued weakness, then re-enters on premature breakouts that lack sufficient cause because volume relationships were never properly analyzed. This archetype represents the triumph of technique over understanding, mistaking the tools of analysis for insight itself, treating symptoms rather than diagnosing the underlying structural condition. The pattern drifter's methodology functions reasonably well during established trends but fails systematically during the transitional phases where the most substantial opportunities emerge. Momentum indicators remain neutral or negative throughout accumulation because price deliberately oscillates within ranges, providing no clear directional signals until markup begins. By then, the mathematical advantage has evaporated. Stops must be placed at much wider distances, and the pattern drifter finds himself chasing moves rather than participating in their systematic foundation at optimal risk-reward ratios. The pain-averse trader demonstrates perhaps the most psychologically understandable yet financially destructive response to accumulation patterns. This archetype possesses theoretical knowledge of Wyckoff principles, can describe springs and tests with technical precision, yet cannot execute when the market provides structural, invitations because recent memory emphasizes downside risk over current opportunity. Having endured the emotional trauma of the preceding markdown, the pain-averse trader cannot psychologically commit capital when price returns to levels that previously produced losses, even when effort versus result relationships clearly indicate that market structure has fundamentally transformed. When a spring penetrates support, this trader experiences the entire markdown trauma again, triggering fight or flight responses that override analytical judgment despite obvious structural evidence of absorption. The successful test of the spring, which should represent maximum opportunity with minimum risk, instead feels like a carefully disguised trap because the price level itself carries emotional baggage from previous losses. Recency bias systematically overweights recent painful experiences while underweighting current structural evidence, creating a psychological prison where fear of repeating past mistakes prevents recognition of present opportunities. This archetype illustrates how emotional pain can persist long after the market conditions that created it have fundamentally changed, transforming what should be systematic advantage into psychological paralysis. The pain-averse trader wants accumulation to feel emotionally safe, springs to appear obviously bullish, and tests to provide reassurance rather than mathematical edge. This emotional framework systematically prevents recognition of the very conditions that create the most favorable risk-reward opportunities, because maximum safety often coincides with maximum discomfort in markets governed by supply and demand dynamics. These psychological patterns manifest in execution errors that repeat with such predictable consistency that professional traders learn to anticipate and systematically exploit them. Selling springs because they appear as breakdowns represents the most costly mistake, transforming optimal accumulation entries into poorly timed exits that deliver inventory to the composite man, precisely when his absorption campaign reaches completion. The spring is deliberately designed to trigger this response, creating artificial supply that professionals systematically absorb, while weak holders surrender positions at the worst possible mathematical moment. Buying late after markup becomes obvious represents another systematic error, confusing confirmation with opportunity and comfort with edge. By the time accumulation becomes apparent through sustained breakouts and positive momentum, the mathematical advantage has shifted dramatically. What once offered tight risk parameters and substantial reward potential now requires wider stops and offers compressed upside, completely reversing the risk-reward mathematics that make systematic trading profitable over time. Perhaps the most insidious error involves abandoning valid setups because individual candlesticks appear visually unappealing despite structural validity. The successful test of a spring often produces narrow bodies, long wicks, and indecisive closes that feel uncertain rather than revealing the market's systematic rejection of both higher and lower prices. These apparent visual imperfections actually demonstrate that equilibrium has been achieved and absorption is complete. Yet traders conditioned to seek emotional comfort mistake structural strength for technical weakness. Wyckoff's timeless admonition resonates directly with these psychological pitfalls. Hope destroys capital while logic preserves it through systematic decision-making. Hope represents the emotional desire for markets to behave according to comfort, rather than according to the structural evidence they actually present. The hopeful trader demands that accumulation feel safe, that springs appear obviously bullish, and that tests provide emotional reassurance rather than mathematical advantage. This emotional framework systematically prevents recognition of conditions that create the most favorable opportunities, because professional accumulation relies on the crowd's reluctance to act when the mathematics are most favorable. Logic, conversely, demands accepting what the market reveals rather than imposing what the mind prefers to see. Logical analysis recognizes that optimal opportunities often arrive disguised as apparent problems, that maximum safety frequently coincides with maximum discomfort, and that the crowd's emotional responses create the very conditions that systematic traders can exploit. When large effort produces small downward result during apparent breakdowns, logic suggests absorption rather than weakness. When springs recover with authority and subsequent tests arrive quietly with dehydrated volume, logic suggests structural completion rather than continued uncertainty. The systematic antidote to these psychological barriers requires pre-commitment to processes that function independently of emotional comfort or narrative coherence. Maintaining detailed accumulation checklists forces attention towards structural evidence rather than headline interpretation. demanding objective verification of selling climax, automatic rally, secondary test, and absorption evidence before considering any capital commitment. This systematic approach directly counteracts the news follower's narrative bias by requiring price and volume confirmation regardless of prevailing sentiment or fundamental analysis. Demanding test confirmation before entry protects against the pattern drifter's tendency to chase premature signals or rely on indicators that lack structural foundation. The spring must recover with expanding volume that exceeds the breakdown volume. The test must arrive on contracted volume with narrow spreads, and the danger point must offer clearly defined risk parameters before systematic participation becomes justified. This discipline prevents technical pattern recognition from overriding the structural analysis that creates sustainable edge over multiple market cycles. Defining mechanical invalidation levels before entry protects the pain-averse trader from emotional decision-making during periods of temporary adverse price action. When stop levels are predetermined based on structural logic rather than emotional comfort, positions can be maintained through normal market noise while capital is preserved when the structural thesis proves incorrect. This mechanical approach prevents the psychological pain of recent losses from contaminating current analytical judgment, creating objective criteria that govern decisions regardless of emotional state. Journaling effort versus result observations in real time creates an objective record that counteracts the selective memory, feeding confirmation bias, and hindsight distortion. When volume and price relationships are documented as they occur rather than interpreted retrospectively, patterns of absorption or distribution become clear, regardless of the emotional comfort they provide. This practice transforms subjective interpretation into objective measurement, creating accountability to structural evidence rather than emotional preference or narrative comfort. The moral insight emerging from understanding these psychological barriers reframes market discomfort as opportunity signal when structural and volume evidence align with Wyckoff's systematic principles. Professional success requires adopting the composite man's patient, methodical mindset, rather than fighting against orchestrated market movements designed to exploit predictable emotional responses. The professionals who control substantial capital have learned to think in campaigns rather than individual trades, in cause and effect rather than hope and fear, in structural completion rather than emotional satisfaction. This perspective transformation represents the fundamental difference between systematic traders and the majority who provide their counterparty liquidity. While the crowd seeks emotional comfort and narrative coherence, systematic traders pursue mathematical advantage and structural evidence. While the majority demands certainty before acting, professionals act when probability tilts favorably regardless of emotional comfort. While most traders hope for obvious signals, systematic traders recognize that the most valuable opportunities arrive disguised as apparent problems that trigger the psychological responses, keeping the crowd systematically sidelined. The recognition of these psychological patterns within oneself creates the foundation for behavioral modification, transforming market blindness into systematic insight through disciplined application of proven principles. The trader who understands why 90% misaccumulation can join the minority who recognize it, not through superior intelligence or privileged information access, but through the discipline to act systematically when structural evidence provides clear invitation while maintaining patience when conditions lack proper confirmation. This discipline, more than any technical knowledge or analytical sophistication, separates successful systematic traders from the majority who remain perpetually confused by markets that operate according to consistent principles they have never learned to recognize or respect. When one learns to treat quiet volume as evidence rather than absence, narrow spreads as confirmation rather than uncertainty, and uncomfortable price action as invitation rather than warning, the compass shifts from how it feels to what it actually is. The market has always been honest about accumulation. It simply refuses to speak in the language of reassurance or emotional comfort. It speaks through absorption, through tests, through volume that fails to move price the distances it should if weakness were genuine. Those who learn this language step out of the 90% not by predicting what comes next, but by systematically obeying what is already clearly present in the tape's honest testimony. The mastery of accumulation analysis transcends the mere recognition of patterns or the mechanical application of rules, evolving into the systematic integration of Wyckoff's laws, structural phases, execution methodology, and psychological discipline into a unified operating system that functions reliably across varying market conditions and emotional states. This transformation represents the fundamental shift from hoping the market will cooperate to systematically recognizing when cooperation is most probable, from predicting future price direction to participating when structural evidence suggests favorable mathematics, from emotional decision-making to systematic response based on objective criteria that function independently of comfort or narrative coherence. The integrated framework operates through sequential logic that builds confidence through repetition and validation rather than seeking dramatic revelations or obvious signals that rarely materialize until opportunities have passed. This systematic approach begins with disciplined diagnosis, examining markets for evidence of legitimate cause development, rather than imposing wishful interpretations on insufficient evidence. The trader learns to distinguish between mere consolidation and genuine accumulation through the patient application of effort versus result analysis, seeking the telltale signatures of professional absorption that transform seemingly random price oscillations into readable evidence of institutional campaign development. Within established trading ranges, the systematic framework demands rigorous verification of structural components before considering any capital commitment. The selling climax must demonstrate genuine exhaustion through panic volume, wide spreads, and the automatic rally that follows when selling. Pressure suddenly evaporates. The secondary test must confirm through diminished volume and effort that major supply has indeed been absorbed, not merely temporarily overwhelmed. These are not theoretical concepts but measurable events that either occur with proper characteristics or fail to materialize with sufficient conviction to justify systematic participation. The effort versus result relationship becomes the trader's primary navigation tool throughout this diagnostic phase, transforming apparent market confusion into systematic evidence of professional activity. Each down move within the accumulation range must be measured not merely by its price progress but by the relationship between volume expended and distance achieved, seeking the characteristic signature of large effort, producing progressively smaller downward results that indicates professional absorption, systematically overwhelming weak hand selling pressure. Conversely, up moves begin requiring less effort to achieve meaningful progress. As selling pressure diminishes, though premature breakouts often stall to maintain the range-bound appearance that keeps competing demand sidelined until accumulation reaches completion. The structural invitation emerges through springs, terminal shakeouts, or last points of support, following clear signs of strength, each representing stress tests of the underlying absorption that has been methodically built during the tedious Phase B construction period. A spring must prove itself through volume expansion on recovery that exceeds the breakdown volume, swift reclamation of the violated range, and subsequent testing that arrives quietly with contracted volume and immediate rejection of lower prices. This sequence represents not pattern recognition but structural verification that forced selling has been exhausted, and that professional capital will no longer permit price to revisit those levels without organized resistance. When accumulation develops, without dramatic springs, signs of strength provide alternative structural confirmation through price gaps, widespread advances on expanding volume, or sustained closes, near session highs despite intraday volatility. The pullbacks to test these signs create last points of support, where former resistance holds as support, each offering precise danger points where risk can be defined tightly, while reward potential encompasses the entire effect that accumulated cause should theoretically produce. These stepping stone patterns demonstrate through price action itself that the balance of power has shifted decisively toward demand and that the structural foundation now supports higher prices. Execution at the danger point operationalizes the entire analytical framework by compressing distance to invalidation while preserving access to substantial reward potential, creating the asymmetric mathematics that justifies systematic participation over emotional speculation. The danger point represents the precise intersection where accumulated evidence transforms into mathematical advantage, where risk can be defined to the tick, while reward potential extends across the entire range and beyond. This is not gambling disguised as analysis but systematic participation where the market itself has provided clear structural invitation with measurable risk parameters and logical invalidation criteria. Position sizing at danger points requires calibrating risk to the magnitude of cause that has been systematically built during the accumulation campaign. Recognizing that ranges requiring weeks to absorb supply imply modest effects, while ranges demanding months, suggest campaigns worthy of substantial patience and appropriate position size. The mathematical advantage compounds through the compressed distance to invalidation, typically representing 1 to 3% of entry price, contrasting sharply with potential rewards that may encompass 10 to 30% advances when substantial cause has been properly constructed and absorbed through professional campaign execution. The psychological integration of this systematic approach provides the antidote to the emotional decision-making that prevents most traders from executing with consistency over extended periods. Pre-commitment to systematic processes protects against the natural human tendency to seek confirmation from external sources rather than trusting the honest testimony provided by price and volume relationships. Maintaining detailed accumulation checklists forces attention toward structural evidence rather than headline interpretation, requiring objective verification of each phase before considering capital commitment and preventing emotional shortcuts that contaminate systematic analysis with wishful thinking or narrative bias. Professional humility emerges as a crucial component of systematic success, emphasizing probabilities rather than prophecies, and attributing results to systematic application rather than predictive genius or exceptional market timing ability. Even the most carefully analyzed accumulation patterns can fail to produce expected results due to broader market conditions, sector rotation, or individual security factors that override structural considerations. The systematic approach protects against these failures through position sizing appropriate to inherent uncertainty and invalidation levels that preserve capital when structural assumptions prove incorrect, transforming apparent losses into valuable data points rather than capital destruction. This reframe of stop trades as market tuition rather than analytical failure maintains psychological resilience and preserves confidence in the systematic approach while remaining flexible about individual applications. A stop test indicates that cause development was incomplete or that broader market forces were overwhelming individual security structure. Protecting capital for authentic accumulation campaigns while providing education about market dynamics that cannot be learned through theoretical study alone. The systematic trader views these experiences as necessary investments in market education rather than evidence of methodological failure, maintaining systematic discipline while accumulating practical wisdom through direct market engagement. The practical implementation of this integrated methodology requires developing specific rituals that reinforce systematic discipline and protect against emotional contamination during periods of temporary adverse price action or narrative confusion. Pre-market scenario rehearsal prepares the systematic trader for various outcomes rather than hoping for specific results, creating mental frameworks for responding to springs, failed tests, premature breakouts, or extended consolidation periods. This preparation transforms reactive decision-making into proactive response because probable scenarios have been considered and appropriate responses predetermined based on structural logic rather than emotional comfort or narrative preference. Journaling every structural observation in real time creates an objective record that counteracts the selective memory and hindsight bias that contaminate most trading analysis, documenting effort versus result relationships as they occur rather than interpreting them retrospectively through the lens of subsequent price action. This practice transforms subjective interpretation into objective measurement, creating accountability to structural evidence rather than emotional preference, while building a database of market behavior that improves pattern recognition and execution quality over multiple market cycles. The systematic framework creates a feedback loop where successful application builds confidence in the methodology, which improves execution quality, which produces better results, which reinforces systematic discipline, and creates sustainable edge through consistent application, rather than depending on exceptional insight or market timing ability. This positive cycle contrasts sharply with the destructive patterns that plague discretionary traders who lack systematic frameworks, where poor results erode confidence, which degrades execution quality, which produces worse results, creating downward spirals that often end in complete abandonment of analytical discipline. Risk management philosophy underlies every aspect of systematic accumulation, recognizing that preservation of capital takes precedence over profit maximization in any individual opportunity, while understanding that the mathematics of danger point entries favor patient, disciplined execution over extended periods. The compressed distance to invalidation creates favorable risk-reward ratios, but these mathematics only function when stops are honored without exception. And position sizing reflects the uncertainty inherent in all market analysis, accepting small, defined losses as the cost of participating in opportunities with substantial reward potential. The integration extends beyond individual security analysis to understanding how accumulation patterns interact with broader market conditions, sector dynamics, and institutional flows that can either support or overwhelm individual security structure. The systematic trader develops sensitivity to these broader forces while maintaining focus on the structural evidence that creates mathematical advantage, balancing individual security analysis with market context in ways that improve overall execution quality and prevent systematic approaches from being overwhelmed by macro forces that invalidate micro-level structural analysis. This comprehensive understanding transforms mechanical rule following into intuitive recognition of how professional capital operates within market structure, how crowd psychology creates systematic opportunities, and how disciplined patience rewards those who align with structural evidence rather than fighting against orchestrated campaigns designed to exploit predictable human responses. The trader learns to read the market's honest language of absorption, effort, and result, while developing the psychological discipline to act when invited and stand aside when not invited, creating sustainable edge through systematic application of proven principles rather than hoping for exceptional insight or market cooperation. The path forward from accumulation mastery extends naturally to understanding distribution phases where the same principles operate in reverse, revealing how professional capital systematically transfers inventory from strong hands to weak hands at elevated price levels through upthrusts, failed rallies, and the systematic removal of demand that precedes markdown phases. The trader who understands absorption can recognize its opposite, developing comprehensive market literacy that functions across varying conditions and time frames through consistent application of structural analysis and effort versus result measurement. Advanced applications emerge from this foundation, including cause measurement through point and figure techniques that project potential effects with mathematical precision, sector rotation strategies based on relative accumulation and distribution patterns across multiple securities simultaneously, and the integration of accumulation analysis with broader market cycle recognition that improves timing and position sizing decisions across entire portfolios rather than individual positions. The systematic trader who achieves this integration has moved beyond hoping for market cooperation to systematically recognizing when cooperation is most probable, and beyond emotional decision-making to systematic response based on objective criteria, beyond individual trade focus to campaign thinking that aligns with professional capital rather than fighting against its methodical operations. This transformation represents the fundamental difference between systematic traders and the majority who provide their counterparty liquidity, creating sustainable edge through disciplined application of proven principles, rather than depending on exceptional ability or favorable market conditions. The journey from recognizing accumulation to systematic participation culminates in the quiet confidence to act decisively when structural evidence provides clear invitation, while maintaining equal confidence to stand aside when conditions lack proper confirmation. There is no rush, because campaigns recur with predictable regularity. There is no despair, because stopped trades provide instruction rather than condemnation. There is no bravado, because the tape humbles all participants equally. Accumulation ceases to be mysterious or miraculous, evolving instead into structure to be recognized, tests to be verified, risks to be defined, and campaigns to be managed with the patience and restraint that mark professional participation in markets governed by the eternal principles that Wyckoff observed and systematized for those willing to study the tape with discipline, rather than hoping for obvious signals that rarely arrive until opportunities have passed into memory.